Welcome to Financial Insights in Minutes, where we simplify wealth-building strategies and financial news for you.
In today's episode, we're breaking down key insights from today's top real estate market analyses. Get ready for some eye-opening discussions.
We'll be diving into predictions about the future of the U.S. housing market, mortgage refinancing strategies, and the costs you might not expect.
Join us as we summarize expert opinions from Stephan to Ken McElroy and bring you the latest trends.
Let's kick things off with, first, Stephan reveals how recent turmoil in Japan's financial markets is impacting the U.S. economy. Next, Reventure Consulting highlights McDonald's alarming sales decline, emphasizing the widening gap in consumer spending. In our third feature, Vermeulen discusses an imminent economic reset and its potential effects on real estate values. Real estate mindset contradicts general sentiments, arguing a possible cancellation of the Great Depression amid economic woes. BiggerPockets welcomes Dave Meyer to discuss the evolution of real estate investing and the return to fundamental strategies. Ken McElroy details a massive property acquisition in Las Vegas and the strategic value behind it. Christina Smallhorn explores the must-know factors for buying manufactured homes in today's market. Finally, Jason Walter and Jim Black analyze the impact of plunging mortgage rates and whether refinancing is the right move for homeowners. Welcome to the channel. Today we're diving into a pressing concern that has investors sweating. Is America teetering on the edge of a recession?
Absolutely. Recent events, particularly the massive sell-off in Japan, have sent shockwaves through the global markets. It's compelling and, frankly, alarming.
The core thesis here is that Japan's recent financial struggles are having a domino effect on the U.S. markets. The latest performance shows the Dow down over 1,000 points.
Right? And this isn't just a minor dip. It's reminiscent of historical market crashes, raising major concerns about the direction of the economy.
Let's break down the key points. First up, global interconnectedness. What's the scoop?
Countries are intertwined like a complex web. Events in Japan can directly influence what's happening here in the U.S., especially with investments in U.S. treasuries.
Japan's currency is in turmoil, right? What happened there?
Precisely. Japan had to raise interest rates to bolster their plummeting yen, causing panic in the markets and leading to massive sell-offs.
How is the U.S. labor market faring amid all this chaos?
Not great. Job growth has slowed significantly, with a recent bump in unemployment rates indicating potential trouble ahead.
Warren Buffett made headlines too. What's his strategy?
He sold nearly half his stake in Apple right before the market drop. It's all about being ahead of the curve.
What does the future hold for the stock market?
Expect increased volatility. The ongoing sell-off may lead to even more drastic market reactions fueled by fear.
Do you foresee any major policy changes from the Fed?
Definitely. There's talk of emergency rate cuts, but historically, lowering rates often happens when the economy is facing more significant challenges.
Wrap everything up for us. What are the big takeaways?
Navigating these turbulent waters requires patience and strategy. Keeping an emergency fund and diversifying investments are paramount for the foreseeable future. Buckle up, it's going to be a bumpy ride.
Welcome to Reventure Consulting on YouTube. Today, we're diving deep into a troubling trend. McDonald's sales are sinking for the first time since the pandemic.
That's the scoop. Nick Gurley explores how skyrocketing prices and shifting consumer habits are altering the fast food landscape. Let's unpack the mess.
What's at the heart of this McDonald's downturn?
The core thesis is that McDonald's is faced with a significant decline in customer traffic and sales due to skyrocketing menu prices, particularly impacting lower-income consumers.
Let's dig into those key points, starting with the sales decline.
Absolutely. McDonald's recorded its first year-over-year sales decline since the pandemic hit in 2020, with customer traffic plummeting by about 5%.
And those rising prices, what's the story there?
Big Mac meals are now priced around $10. This has led to lower-income customers avoiding McDonald's altogether. It's a recipe for disaster.
Is it just McDonald's feeling the heat?
Nope. This downturn is part of a larger restaurant recession affecting chains like KFC and Taco Bell. People are opting to cook at home more often.
Consumer sentiment matters, right? What's happening there?
Indeed, current consumer sentiment is extremely low. with an index level sitting at 66 as of July 2024. People are feeling the financial squeeze.
What predictions are being made for McDonald's and the fast food industry?
If trends continue, we might see further drops in consumer spending, potentially leading to more closures of fast food chains. It's a rocky road ahead.
To wrap it up, what's the big takeaway from this McDonald's crisis?
High menu prices and changing consumer habits are threatening McDonald's future. They need to adapt or risk becoming irrelevant.
What do consumers want now?
Everyone's leaning towards healthier options and better value. Fast food might have to innovate to stay afloat.
Welcome to Sachs Realty's podcast. Today we're tackling the burning question: are we heading toward a historic economic reset? Our guest today is Chris Vermeulen, an expert navigating the tumultuous waters of market fluctuations.
Chris has been trading in the markets since 1997 and offers invaluable insights into the potential challenges ahead for real estate investors. Buckle up as we unpack this critical topic.
So Chris believes the core thesis here centers around real estate facing a downturn. What specifics did he dive into?
The primary thesis suggests an imminent economic reset, causing real estate values to decline by potentially 30 to 50%. Factors like rising unemployment and a strained economy contribute to this forecast.
Let's break down the key points. First, Chris highlighted the current state of real estate values. What did he have to say?
Chris noted that current real estate values are inflated and that we might see declines of 30 to 50% as conditions worsen, which mirrors the pre-2008 environment.
What impact does rising unemployment have?
Rising unemployment rates lead to increased defaults on loans and mortgages. As more people fall behind, this exacerbates the potential for a downturn in real estate.
And what about investment opportunities? Are they still viable?
Absolutely. Chris emphasizes that savvy investors, especially those who are not overextended financially, could double their wealth during an economic reset by seizing the right opportunities.
What predictions does Chris make about the housing market?
Chris predicts a significant correction in the housing sector, which could ultimately provide favorable conditions for investors looking to buy at discounted rates in the future.
Any further predictions regarding the economy overall?
Yes, he anticipates rising unemployment rates, which could create broader market instability, affecting numerous asset classes.
To sum it all up, what are the major takeaways?
Chris emphasizes the importance of education and managing risk effectively to navigate potential market downturns. This economic reset offers unique opportunities for knowledgeable investors prepared to act.
Any final thoughts?
The key takeaway is preparation. Now is the time to educate oneself on market dynamics and prepare for what's ahead.
Welcome back to Real Estate Mindset on YouTube. Is the Great Depression really canceled, or is there more brewing under the surface? Buckle up, because today's topic is a wild ride through America's financial landscape.
Absolutely. We're diving deep into the implications of government bailouts and how they impact average Americans. Let's get straight to the facts. It's about to get intense.
So what's the main thesis from this video? Are we truly free from the grips of another Great Depression?
The core thesis is clear. Despite assurances from politicians, many argue that bailing out the banking system could lead to dire consequences for everyday Americans, leaving the country vulnerable to an economic meltdown.
Let's break down those key points on bank bailouts. What are we looking at?
Government bailouts are masking the underlying economic issues. Politicians say they protect Main Street, but are actually shifting risks back onto average Americans. Definitely a case of smoke and mirrors.
And the real estate market, what's the latest buzz?
Commercial real estate is deeply troubled, with potential job losses in the pipeline. The massive levels of debt in this sector create an unstable environment that could lead to serious economic repercussions.
Now let's touch on consumer struggles. What's the high tide here?
The stats are alarming. Over 5% of mortgage holders are late on payments, and more than 13% of renters are in the same boat. That's a flash flood of financial distress.
What does the future hold? Any predictions?
As expectations escalate, we could see a significant spike in foreclosures. Plus, consumer trust in the banking system is waning. This erosion could lead to even more unrest in the market.
And what about economic collapse timing? Any buzz?
If these issues aren't addressed, we could be looking at skyrocketing defaults. And once housing market instability sets in, it could lead to a chain reaction of economic decline.
What are the long-term consequences?
If bailouts persist, they will further erode public trust in the system. Plus, the continuous fragility of the banking sector will keep us on a precarious edge. We need to start thinking defensively here.
To wrap it up, what are the crucial takeaways?
The overarching message is clear. Systemic risks from bailing out the banking sector could place us on a collision course with another depression. We urgently need responsible fiscal policies to prevent this.
What's the final call to action?
It's time for the government to address these core issues instead of kicking the can down the road with bailouts. Americans deserve better solutions that create sustainable growth.
Ahoy shipmates, welcome to the 1,000th episode of the BiggerPockets podcast. Today's milestone is more than a number. It's a celebration of a community that's helping thousands reach their financial dreams.
And what a milestone it is. Joining us is none other than Dave Meyer, the captain of our ship going forward. With over 15 years in investing and 8 years here at BiggerPockets, Dave knows the ropes like few others.
So what's the main thesis here? What changes are in store?
The essence is clear. BiggerPockets is focused on going back to the roots, emphasizing hype-free real estate investing, genuine advice, and fundamental investing tactics while looking ahead to the future.
Let's dive into the key points of this new adventure. What's on the horizon?
BiggerPockets is evolving with a 2.0 plan, emphasizing authentic investor stories, cutting down on ads for a smoother experience, and delivering 3 exciting episodes weekly.
And what about the investing principles they're prioritizing?
They're back to basics. Strategies and tactics that work in 2024 will take center stage with a focus on creating mutual benefits for everyone in real estate.
How about today's market? What's the situation for would-be investors?
Current conditions are challenging with high prices and rates, but house hacking is still a robust strategy. Also, the community is invited to send in feedback to shape future content.
Time to whip out that crystal ball. What predictions do we have flowing in?
The outlook includes a deeper engagement from investors focusing on long-term strategies and an uptick in creative financing options.
What about community growth? What's cooking there?
With enhanced community interaction, we can expect higher success. Plus, content will continually evolve based on listener feedback, making it a win-win.
And as we sail toward the wrap-up, what should everyone take away from this?
Navigating through hype-free investing, a focus on community success, and a commitment to solid fundamentals will keep BiggerPockets at the forefront for the next 1,000 episodes and beyond.
And what about the listener's role in all this?
Listeners are encouraged to engage via feedback, showcasing that the future of BiggerPockets relies on everyone's input for continuous improvement.
Welcome to Ken McElroy's channel. Today we're diving into the details of a jaw-dropping $90 million property purchase.
Absolutely. Ken brings years of expertise, having successfully completed billions of dollars in real estate deals. Get ready for some serious insights.
What's the central theme of Ken's video? What's this remarkable deal all about?
The focus is on acquiring a $90 million property while navigating higher interest rates. Ken emphasizes the opportunity stemming from strong market fundamentals and the property's value-add potential.
Let's break down the key points of this property purchase. First up, what's the deal on pricing?
Ken highlights acquiring at $261,000 per unit. That's a steal considering current build costs are over $300,000.
And talking about investment, how much skin does Ken have in the game?
Ken is personally investing $2 million. Plus, the property is severely undermanaged, indicating strong potential for value creation.
What's the projected growth for this property?
Ken anticipates an $800K potential rent increase thanks to the strategic location in the upscale Green Valley Henderson area.
What makes the Las Vegas market so appealing for this investment?
Ken points out that Las Vegas is experiencing high demand with only a handful of new units being built. That's a recipe for success.
What does Ken predict for the future of this market?
He foresees a shortage of apartments by 2027 due to construction slowdowns, which could lead to a surge in rent growth. Watch out for that.
Any strategies for getting returns on this deal?
Ken plans to improve operations for refinancing within a 5 to 7 year horizon. Smart move.
So what are the big takeaways from Ken's venture?
Ken emphasizes the importance of acquiring undervalued properties that generate immediate cash flow while also mitigating risks through strategic management. It's an exciting journey worth following.
Any final words to investors watching this?
Yes, always look for properties with strong growth potential in stable markets. Ken's insights are a fantastic guide.
Welcome aboard to today's session on buying manufactured homes. With rising housing costs, this topic has never been more relevant. Let's navigate these waters like pros.
Absolutely. We're diving into various options for purchasing a manufactured home. Christina Smallhorn, a real estate expert, will shed light on the complexities of financing and choosing the right home.
So what's the main thesis here? Why is this topic so crucial?
The core thesis is that with the right preparation, buyers can navigate the complexities of financing and selecting a manufactured home successfully. Christina emphasizes comprehensive planning and utilizing available resources.
Let's break down Christina's essential points, starting with how to choose a lender. What insights can you share?
Firstly, selecting lenders who specialize in manufactured homes is pivotal. Interest rates tend to be higher than traditional homes, so knowledge is crucial.
Now, what's the scoop on property disclosures?
Christina insists on obtaining property disclosures during viewings. They provide a history of the home's condition, allowing informed decisions.
What should potential buyers remember during house tours?
During tours, Christina recommends checking ceilings for water stains and inspection beneath for cleanliness. It's all about spotting potential issues.
Now, any predictions Christina has on the housing trends?
Christina forecasts that interest in manufactured homes will rise as housing prices stabilize, coupled with innovations improving manufacturing quality.
Wrapping it up, what's the ultimate takeaway from Christina's insights?
It's all about preparation. Knowledge about financing, property disclosures, and inspection details empowers buyers to make informed decisions. Knowledge is key.
Ahoy there! Welcome back to Jason Walters' channel. Today we're navigating the waters of mortgage refinancing with a serious decrease in rates.
Yes, we're diving into whether it's a good time to refinance as mortgage rates hit the lowest levels since last April. Joining to share his insights is Jim Black, the mortgage maestro with 20 years of experience.
What's the core message in today's discussion? What should viewers be on the lookout for?
The primary thesis is simple. With mortgage rates dipping, it's time for homeowners to reassess the refinancing landscape. Jim emphasizes that understanding individual goals and timeframes is crucial before making any moves.
So, how low are we talking here? What's the current mortgage scene all about?
Mortgage rates have plummeted to between 6.4 and 6.5%, the lowest level since last April. That's quite the drop at 75 points within just a month.
Jim, when should someone seriously consider refinancing?
Individuals need to look at their refinancing objectives and timelines. For example, if you plan to stay in your house for fewer than two years, it may not be worth it unless it's at no cost.
What about the dreaded closing costs? Are there alternatives?
Yes, you can either pay closing costs up front or roll them into the new loan amount. Understanding which option saves you more money in the long run is vital.
Everyone loves a good break-even point. What advice does Jim have here?
To determine whether refinancing is worthwhile, you need to know your break-even point. Ideally, you want to recover your costs within 3 years.
Here's something fascinating. Can homeowners negotiate rates after they've locked them in?
Absolutely. With certain lenders, if rates fall during your transaction process, you can renegotiate for a better deal. Plus, existing appraisals can sometimes be reused.
What can we expect in terms of refinancing activity?
Expect a surge in refinancing activity. Many homeowners bought homes in the last couple of years and now could seriously save with these lower interest rates.
What should homeowners take away from this?
The crucial takeaway is to examine personal goals and timelines carefully. Refinancing could be advantageous, especially with these enticing mortgage rates. Make informed decisions.
Now's the time to ask, should homeowners act quickly?
Yes, with rates steadily decreasing, this is a golden opportunity for many to maximize their savings. Seriously, reach out for refinancing options.
In this episode, we explored how Japan's market turmoil may signal trouble ahead for the U.S., as discussed by Stephan.
Chris Vermeulen shed light on potentially drastic changes to real estate values during an anticipated economic reset.
Contrasting views from hosts emphasize the need for strategic insights amidst rising costs and inflation, particularly in the housing market.
From Ken McElroy's optimistic outlook on undervalued properties to Christina Smallhorn's warnings about manufactured homes, today showcase the rich complexity of real estate investing.
Thanks for watching Financial Insights in Minutes for August 7th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.